Welcome back, viewers. If you're looking to boost your real estate investment game and maximize your profits, you're in the right place. We're about to delve into the fascinating world of real estate ROI return on investment. This, my friends, is the compass that guides savvy investors through the vast ocean of opportunities that is the real estate market. Now, while you're here, do us a favor and hit that subscribe button. Ring the notification bell too, so you're always in the loop with our latest real estate insights and tips. Trust us, you don't want to miss out. Alright, let's get down to business. Real estate ROI is the holy grail of investing. It's a measure of how well your money is working for you, how profitable your investment is relative to its cost. It's the yardstick by which all investments are measured, and the key to unlocking your investment potential. But what is ROI, really? In the simplest terms, it's a percentage that tells you how much money you've made from an investment compared to what you put into it. Think of it as the profit on your investment, expressed as a proportion of the original cost. But here's the best part. Calculating ROI isn't rocket science. You don't need a PhD in finance or a supercomputer to figure it out. All you need is a clear understanding of the basics and a bit of practice. So why is understanding ROI so important for real estate investors? Well, because it gives you a clear picture of the profitability of your investments. By comparing the ROI of different properties, you can identify the most profitable opportunities and make informed decisions about where to invest your money. So, whether you're a seasoned investor looking to fine-tune your strategy or a newbie just dipping your toes into the real estate waters, mastering ROI calculation is crucial. It's the first step towards building wealth in real estate, and a powerful tool in your investment toolkit. Alright, let's get down to business. Real estate ROI is the holy grail of investing. It tells you how profitable your investment is relative to its cost. And guess what? Crunching the numbers isn't as daunting as it sounds. The formula for ROI is simple. Net profit, cost of investment, x 100. But wait, what exactly counts as net profit? And how do you calculate the cost of investment? Let's break it down. The first part of our formula is net profit. It's your income from the property, but it's not just a simple total of the rent checks you've cashed. To get your net profit, you need to subtract all your costs associated with the property from your total income. These costs include things like property taxes, maintenance costs, mortgage payments, and even the cost of marketing the property for rent. Now let's talk about cost of investment. This is more than just the price you paid for the property. It includes all the additional costs you incurred to make the property rentable. These can be closing costs, renovation costs, repair costs, and any other costs you've had to cover to get the property up to snuff. So if you think about it, the formula is really telling you how much profit you've made compared to how much you've invested. It's a percentage that shows how effectively you've used your money to generate income. Let's put it into context. Imagine you bought a property for $200,000. You've spent an additional $50,000 on renovations and repairs. Your total cost of investment is therefore $250,000. Now, let's say you've been renting this property out, and after all expenses, you've made $20,000 in a year. That's your net profit. To calculate your ROI, you divide your net profit, $20,000, by your cost of investment, $250,000, and then multiply by 100. This gives you an ROI of 8%. Net profit includes your rental income, minus expenses like property taxes, maintenance costs, and mortgage payments. Your cost of investment covers the purchase price, closing costs, and any renovations or repairs. So there you have it, a breakdown of the ROI formula. Understanding this calculation is a key step in your journey to becoming a savvy real estate investor. Let's say you buy a rental property for $200,000. By the end of the year, after all expenses and costs, you've earned a net profit of $20,000. Now, we're going to use these figures to calculate our ROI. First, we take the net profit, which is $20,000. We then divide this by the cost of our investment, in this case, $200,000. The result of this division is a decimal, 0.1. But we're not done yet. To turn this into a percentage, which is how ROI is typically expressed, we multiply the decimal by 100. So our ROI for this investment is 10%. Not too shabby, right? Now let's take a step back and see what this 10% means. It tells us that for every dollar we invested in this property, we've made a return of 10 cents within a year. This might not sound like much, but when you're dealing with large sums of money, even a small percentage can translate into significant profits. And that, my friends, is the power of understanding ROI. It's not just about crunching numbers, it's about gaining valuable insights into your investments and using them to make smarter, more profitable decisions. Consider this: without knowing the ROI, you might be tempted to invest in a property just because it's cheap. But with ROI, you can see if that cheap property is actually a good investment or a money pit. Understanding ROI is crucial because it helps you evaluate the profitability of different investment opportunities. Whether you're flipping houses or buying rental properties, knowing your ROI ensures you're making informed decisions and maximizing your returns. And there you have it, folks. The key to unlocking your real estate investment potential. Remember, mastering ROI calculation is the first step towards building wealth in real estate. Let's take a quick stroll down memory lane to summarize what we've learned today. We started with the importance of return on investment, or ROI, in real estate and why it's considered the holy grail of investing. It's the magic figure that tells you just how profitable your investment is relative to its cost. We then broke down the ROI formula into bite-sized chunks, showing you that it's really as simple as dividing your net profit by your cost of investment and then multiplying the result by 100. And remember, net profit isn't just your rental income, it's that income minus your expenses. Likewise, your cost of investment isn't just the purchase price, it includes all those closing costs, renovations, and repairs too. We then put theory into practice with a hypothetical example, demonstrating how to calculate ROI for a rental property. The example showed us that with a net profit of $20,000 and an investment cost of $200,000, the ROI would be a solid 10%. So, why is all of this important? Because understanding ROI allows you to evaluate the profitability of different investment opportunities. Whether you're flipping houses or buying rental properties, knowing your ROI ensures you're making informed decisions and maximizing your returns. Remember, real estate investment isn't just about buying and selling properties, it's about understanding the numbers behind your investments and using them to your advantage. It's about being smart, strategic, and savvy. So here's your call to action. Start using the ROI calculation in your real estate investments. See how it can help you make better investment decisions and maximize your profits. Don't forget to subscribe to Realty Solutions for more valuable insights and tips on all things real estate. Until next time, happy investing!